There's a pattern in financial history that repeats with mathematical precision. Every single time trust in institutions collapses, every time governments debase their currency, every time the public loses faith in paper promises, silver explodes. Not gradually, violently, and right now, in 2025. We're watching the exact same setup that preceded every major silver spike in the last 2,000 years. The Roman Empire, Weimar Germany, the Hunt brothers in 1980, 2011's silver surge. Every single time, the pattern was identical. Currency, debasement, loss of confidence, flight to real assets, and silver moved faster and harder than anything else. Here's what should terrify you. We're not approaching that moment. We're already inside it. Trust is collapsing right now. The currency is being debased right now. Silver, which has been suppressed and ignored for decades, is about to do what it always does when the system breaks. It's going to explode. Let me show you why this happens, why it's happening again, and why silver specifically is the asset that captures the panic when paper promises fail. Before we understand why silver explodes during trust collapse, you need to understand what silver actually is. It's not as an investment, as money. For 5,000 years of human civilization, silver was money, not a commodity, not an investment vehicle. Money, the medium of exchange that facilitated trade across continents and centuries. Gold was always too valuable for daily transactions. Couldn't buy bread with gold. But silver was perfect. Valuable enough to store wealth, common enough to use in commerce. The Roman denarius was silver. The British pound sterling was originally defined as a pound of silver. The Spanish piece of 8, silver. The American dollar, before 1965, 90% silver. This wasn't arbitrary. This was thousands of years of human experience determining that silver works as money because it has the properties money requires. It's divisible, durable, portable, scarce, and impossible to counterfeit or create from nothing. That last part is critical. You cannot print silver. You cannot decree silver into existence. You have to mine it, refine it, mint it. There's a physical cost. There's real scarcity. And that's why, when paper money fails, when trust in government promises collapses, people return to silver. Because silver can't lie. Silver coin is what it is. 1 ounce of silver, no promises, no counterparty risk, no government backing required. It's real, tangible, and immune to debasement. This is why silver explodes during trust collapses. It's not speculation, it's not investment mania. It's people fleeing from paper promises back to real money. And when that happens, when millions of people simultaneously decide they'd rather hold metal than paper, the price doesn't drift up. It rockets. Let's look at the pattern historically. Start with Rome, 200 to 300 AD. The Roman Empire at its peak was the wealthiest civilization in human history. Their currency, the denarius, was respected everywhere. In 64 AD, the denarius was 95% silver, pure, trusted, valuable. But Rome had a problem. Continuous wars, massive military expenses, public welfare programs, and tax revenues that couldn't keep pace. So, what did they do? Exactly what every empire does. They debased the currency. By 100 AD, the denarius was 85% silver. By 200 AD, 50% silver. By 270 AD, less than 5% silver. The coin looked the same. The face value was the same. But the real metal content had collapsed, and what happened? Inflation exploded. Prices increased 1,000% over 100 years. Trade broke down. Citizens stopped trusting the currency. And silver, real silver, became impossible to obtain at official prices. People hoarded it. Merchants demanded payment in pure silver, not debased coins. The black market price of silver exploded while the official denarius collapsed. This is the first recorded pattern. Government debases currency. Trust collapses. Silver hoarding begins. Black market premiums surge. The empire eventually fell, but the silver retained value. The coins that survived are worth more today than when they were minted 1,700 years ago. The paper promises of Rome are dust. Silver is still silver. Jump forward 1,600 years. Germany, 1919 to 1923. The The Weimar Republic is the textbook example of currency collapse and why silver explodes. After World War I, Germany owed massive reparations. They couldn't pay with tax revenue. So, they did what every government does. They printed money. In 1919, there were 30 billion marks in circulation. By 1923, 500 quintillion marks. That's 500 with 18 zeros. The currency was worthless. A loaf of bread that cost 1 mark in 1919. It cost 200 billion marks in 1923. Workers were paid twice a day because by evening the money would lose half its value. People used wheelbarrows full of cash to buy groceries. This is hyperinflation. It's total collapse of trust in paper money. And what happened to silver? It exploded. In 1919, you could buy an ounce of silver for 12 marks.
Boys.
By 1923, that same ounce cost trillions of marks. But here's the key. If you held silver through the collapse, you preserved your wealth. An ounce of silver in 1919 bought a nice suit. An ounce of silver in 1923 still bought a nice suit. The mark collapsed. The silver held. People who trusted the government and held paper lost everything. People who converted to silver survived. This is the pattern. When trust collapses, when currency is debased beyond recognition, silver doesn't just go up in price. It becomes the only thing that holds value. Everything else, stocks, bonds, real estate priced in worthless marks, all collapsed. But silver remained real. Now let's jump to the most dramatic modern example. The Hunt brothers, 1979 to 1980. This is when silver went from $6 per ounce to $50 per ounce in 18 months. The largest silver spike in modern history, and it happened because of exactly what we're talking about. Trust collapse. In the 1970s, America faced stagflation. High inflation, economic stagnation, the dollar losing value. Nixon had closed the gold window in 1971. The dollar was no longer backed by anything, just government promises, and people were losing faith. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, were Texas billionaires who understood what was happening. They saw the dollar being debased. They saw inflation eroding wealth. And they decided to buy silver, massive amounts of silver. By 1979, the Hunts controlled over 100 million ounces of silver. That's 1/3 of the entire global supply available for investment. They weren't just buying paper contracts. They were taking physical delivery, actual metal, stored in vaults. This created a supply crisis. Investors saw what the Hunts were doing and followed. Everyone wanted physical silver. Demand exploded. Supply dried up. The price went parabolic. In January 1979, silver was $6 per ounce. By January 1980, $50 per ounce. That's a 733% increase in 12 months. This wasn't gradual appreciation. This was panic buying.
Ow.
People fleeing dollars into metal. And silver moved faster than gold because silver was cheaper. More people could afford it. More industrial uses required it. And the supply was tighter. But here's what happened next. The government intervened. The COMEX exchange changed the rules. They implemented position limits. They restricted buying. They forced liquidation. On March 27, 1980, Silver Thursday, the price collapsed from $50 to $10 in a single day. The Hunts were bankrupted. The squeeze was broken. But the lesson was clear. Silver can move with explosive violence when trust collapses. And the government will intervene to stop it because silver rising is a referendum on the dollar. If silver goes to $100, it means people trust metal more than government promises. And governments cannot allow that narrative. Fast forward to 2011, the next silver explosion. After the 2008 financial crisis, trust in the financial system was shattered. Banks had collapsed. The government had bailed them out with printed money. The Federal Reserve launched quantitative easing, QE1, QE2, trillions of dollars created from nothing. And people started asking the same question they always asked during currency debasement. What's real? What holds value? The answer was gold and silver. From 2008 to 2011, gold went from $800 to $1,900 per ounce. But silver went from $9 to $49 per ounce. That's a 444% increase. Silver outperformed gold by a factor of 2. Why? Because silver has dual characteristics. It's a monetary metal like gold, but it's also an industrial metal. Solar panels, electronics, batteries, medicine all require silver. So when trust collapses and people flee to real assets, silver gets hit with a double demand shock. Monetary demand from investors seeking safety, and industrial demand from companies securing supply. This creates explosive price moves. And 2011 proved it again. Silver moved faster and harder than any other asset, from $9 to $49 in 3 years. But then, just like 1980, it collapsed. From $49 back to $14 by 2015, the usual suspects: paper market manipulation, COMEX position limits, coordinated central bank intervention. The pattern repeated. Silver explodes during trust collapse. Government suppresses it when the explosion threatens dollar credibility. But the suppression never lasts forever, because the fundamentals don't change. And right now, in 2025, we're setting up for the next explosion. This time, it might be the biggest one yet. Here's why the current setup is more explosive than any previous cycle. Start with currency debasement. Since 2020, the United States has printed over $6 trillion. The money supply increased 40% in 2 years. The fastest monetary expansion in American history. The Federal Reserve's balance sheet went from $4 trillion to $9 trillion. Every dollar in existence was devalued by that expansion. And it's not just America. The European Central Bank printed trillions. The Bank of Japan printed trillions. China expanded credit by trillions. Every major currency on Earth has been debased simultaneously. This is unprecedented. In 1980, it was the dollar. In 2011, it was mostly the dollar and euro. But now, every fiat currency is being debased at the same time. There's no safe haven in paper. The euro is inflating, the yen is collapsing, the yuan is controlled by a government drowning in debt. There's nowhere to hide in fiat currency. And when people can't hide in other currencies, they flee to metals. This is the setup for the largest precious metals bull market in history. And silver specifically is positioned for maximum explosion. Here's why silver moves harder than gold. The gold to silver ratio. Historically, silver trades at a ratio to gold of about 15 to 1. That means 15 ounces of silver equal 1 ounce of gold. This ratio is based on the actual scarcity in the Earth's crust. For every ounce of gold, there are approximately 15 ounces of silver. But the ratio fluctuates based on monetary demand. In 1980, during the Hunt brothers squeeze, the ratio collapsed to 17 to 1. Silver was expensive relative to gold. In 2011, it dropped to 31 to 1. Silver was still cheap relative to historical norms. But in 2020, during the COVID crisis, the ratio spiked to 120 to 1. It took 120 ounces of silver to equal 1 ounce of gold. This was the most extreme undervaluation of silver in history. Why? Because silver is traded on paper markets where banks can create unlimited synthetic supply. Futures contracts, ETFs, unallocated accounts, paper silver that doesn't exist physically, but suppresses the price through leverage. As of 2025, the ratio is around 80 to 1. Silver is still historically cheap relative to gold. And when trust collapses, when people demand physical metal instead of paper promises, that ratio will collapse violently. If the ratio returns to its historical average of 15 to 1, and gold is at $2,000 per ounce, silver would be $133 per ounce. That is, a 500% increase from current prices of around $25. But if gold goes to $3,000 during the trust collapse, and the ratio hits 15 to 1, silver would be $200 per ounce. That's an 800% move. This is why silver explodes harder than gold. It's the leverage play on trust collapse. Gold moves. Silver launches. Now let's talk about physical supply dynamics. This is where the current setup becomes truly explosive. Silver is being consumed faster than it's being mined. The world mines about 1 billion ounces of silver per year, but global demand is approximately 1.2 billion ounces per year. There's a structural deficit of 200 million ounces annually. That deficit is being met by above-ground inventories, stockpiles that have been accumulated over decades. but those stockpiles are depleting. COMEX inventories, the registered silver available for delivery, dropped from 300 million ounces in 2022, less than 50 million ounces in 2025. That is an 83% decline in deliverable physical silver. At the same time, industrial demand is increasing. Solar panel production requires massive amounts of silver. Electric vehicles use twice as much silver as traditional cars. 5G infrastructure requires silver. Electronics, medical devices, water purification, all require silver. This industrial demand is inelastic. Companies need silver to produce products. They can't substitute. They must have it. So when monetary demand hits, when investors start buying physical silver because trust in currency is collapsing, the available supply will vanish. There isn't enough silver above ground to meet simultaneous industrial and monetary demand. This creates the conditions for a true supply shock. It's not a price increase, a shortage, where you literally cannot buy physical silver at any price. This has never happened in modern markets, but the math says it's coming. Here's the mechanism that triggers the explosion. The paper market breaks. Right now, silver is primarily traded on the COMEX futures exchange. For every ounce of physical silver, there are approximately 300 paper claims. 300 different entities believe they own the same ounce of silver. This works as long as no one asks for delivery, as long as everyone trades paper contracts and settles in cash. But when trust collapses, people stop trusting paper. They demand physical delivery. And when more than 0.3% of paper contract holders demand delivery, the system breaks. There isn't enough physical silver to deliver. The exchange has three options. 1. Default on delivery. Admit that the paper contracts were fraud. Destroy confidence in the entire market. 2. Cash settle at current prices. Force contract holders to accept dollars instead of silver. This would trigger lawsuits and destroy the exchange's credibility. 3. Let the price rise until supply and demand balance. Allow silver to find its true physical price without paper leverage. Option 3 is what happened in 1980. The price went from $6 to $50 because physical demand overwhelmed paper supply. And it's what will happen again. The only question is timing. And the setup right now suggests timing is imminent. Here are the specific catalysts that could trigger the explosion. Catalyst 1. Central bank policy error. If the Federal Reserve continues printing to fund government deficits, or if they're forced to restart QE to prevent a debt crisis, confidence in the dollar will collapse. People will flee to real assets. Gold and silver will be the primary beneficiaries. Catalyst to geopolitical crisis. If war breaks out, if major trade routes are disrupted, if the global system fractures, trust in government promises evaporates, silver becomes a safe haven, and physical demand spikes. Catalyst 3. COMEX default. If a large buyer demands physical delivery and the exchange cannot deliver, the entire paper market collapses. Physical silver disconnects from paper prices. The real price discovery happens in the physical market. That price could be multiples higher than the paper price. Catalyst 4. Solar demand surge. If governments push aggressive green energy mandates, solar panel production will require billions of ounces of silver. Industrial demand alone could drain available supply and force prices up regardless of monetary demand. Any one of these catalysts could trigger the explosion. All four are in place simultaneously right now in 2025. The setup is complete. The trust is eroding. The supply is tight. Paper market is leveraged beyond sustainability. And history says what happens next. Let's talk about who benefits when silver explodes. It's not institutions, not banks, not governments, individuals, small investors. People who understood the pattern and positioned before the explosion. This is why governments hate silver bull markets. Gold is mostly held by central banks, institutions, the wealthy. When gold rises, the wealth distribution doesn't change much. But silver is the people's metal. It's affordable. Here's what you need to understand about the endgame. Silver exploding isn't a market event. It's a societal signal. It means trust in the system has broken. It means people would rather hold metal than believe promises. It means the currency is failing. This happened in Rome. The denarius collapsed, and real silver became the only trusted money. It happened in Weimar, Germany. The mark became worthless, and silver was the only thing that held value. It happened in 1980, when inflation was out of control and trust in the dollar was eroding. It happened in 2011 after the financial crisis, when people realized the banks were insolvent and the government was printing to cover it up. And it's happening now. We're watching the same pattern unfold in real time. The government is printing trillions. Debt is exploding. Trust in institutions is collapsing. And silver is sitting at $25 per ounce. It's historically cheap, suppressed, ignored, but not for much longer. Because the pattern says when trust collapses, silver explodes. And trust is collapsing right now. You can see it in the polling data. Trust in government at all-time lows. Trust in media at all-time lows. Trust in financial institutions cratering. People know something is wrong. They don't know exactly what, but they feel it. And when that feeling becomes conviction, when people decide to act, they'll do what humans have done for 5,000 years. They'll flee to real money. And silver is real money. Here's the final piece. Why now is different from every previous cycle. In 1980, the government could intervene because most silver trading was domestic. They controlled the exchanges. They could change the rules. In 2011, the intervention was coordinated globally. But physical demand was still manageable because most investors bought paper silver ETFs. They didn't demand physical delivery. But now, in 2025, the game has changed. Retail investors have learned they're buying physical. They're taking delivery. They're storing it outside the banking system. The paper market is losing control. And simultaneously, industrial demand has become critical. Solar, EVs, electronics. These industries cannot function without silver. They must buy physical. They must secure supply. This creates a two-front war for the paper market. Monetary demand from investors and industrial demand from manufacturers. Both demanding physical, both unwilling to accept paper promises. The paper market cannot survive that. The leverage is too high. Physical supply is too tight. When the break comes, it woe and be a 733% move like 1980. It woe and be a 444% move like 2011. It could be 1,000%. It could be 2,000%. Because this time, there's no escape valve. Every fiat currency is debased. Every government is printing. Every central bank is trapped. And the physical silver supply is the tightest it's ever been in history. This is the setup for the explosion of all explosions. The mother of all silver bull markets. And it's not speculation. It's pattern recognition. 3 times before, trust collapsed. Currency was debased and silver exploded. We're in the exact same setup. Deeper debt, more printing, tighter supply, lower trust. The pattern says explosion is coming, so this time it might be the one that breaks the paper market permanently. If you understand this pattern, if you see what's coming, you have a decision to make. Do you trust the government's promises that everything is fine? That the debt doesn't matter? That they can print forever without consequences? Or do you trust 5,000 years of human history that says when trust collapses, real assets win? Paper promises fail, and silver explodes. So the pattern has played out 3 times in the last 2,000 years. Rome, Weimar, 1980, 2011. Every time the same sequence. Currency debasement, trust collapse, silver explosion. We're watching it happen again right now. The debasement is happening. The trust is collapsing. The explosion is next. And when it comes, when silver goes from $25 to $100 to $200 to wherever true physical scarcity takes it, the people who positioned early will experience wealth transfer that changes their lives. Not because they got lucky, because they understood the pattern, because they trusted history. Because they knew that when governments print and promises fail, silver always explodes. This is the pattern. This is the moment. And this is why silver always explodes after trust collapses. Subscribe if you want to see how this plays out, because the explosion is coming. And the early ones, the ones who see it before the crowd, they're the ones who benefit. The pattern doesn't lie, and history is about to repeat one more time.